Welcome to SAIS and to the inaugural Enders Lecture on Canada-U.S. Relations. I'm Charles Duran, the Andrew Mellon Professor of International Relations here and a Director of Canadian Studies for quite some time. Ambassador Tom Enders, already a hugely experienced American diplomat, took up his post as U.S. Ambassador with his wife Gaetana in 1976. This was a time of considerable turmoil for Canada over, for example, the language legislation in Quebec, negotiations between Quebec and the federal government regarding the sovereignty issues. And Tom Enders brought the ability and the experience necessary to deal with these issues. And of course, he and his wife spoke excellent French. But nobody can tell us more about all of this than Gaetana Enders herself. She is truly the dynamic force behind this Enders Lecture series. She is the wonderful inspiration, I guess we would call her the muse, the catalyst behind the brilliant idea of an Enders Lecture at SAIS. And she's with us today.
Should I go here or here?
Wherever you're comfortable.
I'm comfortable here. I'm happy to hear. Well, this is very emotional to be back in Washington, the city of my husband, my city also, after many years. Also, I see some wonderful friends here that I've known all my life, including my son, that I've known also all my life. And I have to say, first of all, many thanks to my host, who is Charles Duran, who is very kind to have us here and recognizing the importance that he has always felt for Canada, and he's a wonderful defensor of U.S.-Canadian relations. And I might say that also we would like to have Professor Knight, who is a very busy man, who is here to tell us a few things. My chairman here, who is wonderful, and we have a Canadian after all. And Gervais is a very senior diplomat also in a way, but also a man of, in a way, he's a medieval person because he knows everybody and knows how to get around everyone. When I say medieval, I think maybe of certain Italian politicians. But Richard is a very close friend, and I thank him for being so fascinated with our intervention here, we Americans for Canada. But I also especially want to thank the Canadian Embassy, who is hosting afterwards, but especially I want to thank my great friend, Ambassador Negroponte. Now, John has been linked with my family for years. He shouldn't be here today because he had a personal problem, but his loyalty is so great to the cause of not only my husband's cause, my love for him, but also the cause of diplomacy and of career diplomats. He's a legend. There are a few legends in the Foreign Service. He's one of them. He had every post that normally we don't get. We who are career, we never get those posts. He got them all. He was ambassador 6,000 times. It's true that he got a hardship post, like Tom. Both of them never shrank. When they were offered a post, that was it. In a way, they were so dedicated to their country that they never shrank against responsibility or toughness. I mean, he was considered a toughie, so was my husband. They were troubleshooters. From Honduras, it wasn't easy with the Contras. He did it. So did my husband. And then that was okay. We defended the United States interests. He did Vietnam too. My husband did Cambodia. I mean, there were very arguments against it, but they did it. And then on to fantastic things, including Mexico, very important, and then also the United Nations, most senior post, cabinet post, first man in intelligence, first post that was created by President Reagan. He did it. And finally, Undersecretary of State. So I think that John Negroponte to me is an example of service. And I want to honor him as my friend, my husband friend, and a great diplomat. John, you're on.
Maybe I'll speak from here also, but thank you very much. Thank you for the warm and kind and friendly introduction. And you're right, Tom and I were great friends and close colleagues, going all the way back to Cambodia, one of those tough assignments to which you were referring. And we used to parachute into Phnom Penh every several months or so with either Al Haig or Henry Kissinger when they were running the National Security Council, and I was the man on Vietnam, the director for Vietnam in Nixon's National Security Council. And Tom's feats in the Foreign Service were truly legendary. And he not only went to difficult assignments, but he went to ones like Cambodia, where there wasn't that much help or support. You had to really be resourceful and do it yourself. I would also remember, I really want to recall Tom's work in the establishment of the International Energy Agency. I was looking at, which is an accomplishment for which I'm not sure he's as well known as he ought to be. Because after the 1973 Middle East War, the boycott of the United States by the Arab oil exporting countries, we were in a state of crisis in this country, and we absolutely had to do something. And Tom was the intellectual architect of this effort to organize vis-a-vis the oil boycott. And I was looking at their website today, and I clicked on the history part, and sure enough, there was a video showing the organizing conference, and Henry Kissinger's there, and Tom in the background. And then I looked at the charter document of the International Energy Agency, and yes, there is Tom Ender's signature as one of the founding signers of that organization. So he should definitely be remembered for that, among many, many other things. And then, of course, there was his time as ambassador to Canada, where again, just as fate would have it, I had the opportunity to intersect with his work there, because I was the Deputy Assistant Secretary of Fisheries for Oceans and Fisheries, with the rank of ambassador, by the way. It was my first ambassadorship, and my wife always tells me, that didn't count. You're only ambassador to the fish. And, but in any event, fisheries, as many of you know, is quite an important and politically charged issue in relationships between countries, and that was nonetheless true in the bilateral relationship with Canada. And it was at the time that our two respective countries had just declared 200-mile resource jurisdiction for fisheries and various types of marine resources. So we had a lot of overlapping claims to resolve between the two countries, which happily now, 30 years later, have been resolved. I gave a speech in Cleveland on the 23rd of March on United States-Canada relations, and obviously I'm not going to read that to you today because it's not my turn to give a lecture, but it was entitled United States-Canada Relationship, Partners for Regional Prosperity and Global Peace. And there are just two parts of this speech to which I would like to refer. One is a little bit of a joke, which is that I was Deputy National Security Advisor when we actually signed the free trade agreement between the United States and Canada. It was something like January 3rd, 1988. It was just after the New Year. And Ronald Reagan and Brian Mulroney signed it by video teleconference. They did it virtually. It wasn't done in person. And so General Powell, who was the National Security Advisor, and myself went in to give President Reagan his normal briefing, which thankfully in his presidency you gave to him at 9:30 in the morning instead of 6:30 in the morning, the way some of these fanatics who came after him would do. And part of our briefing was to tell him that later in the day he would be signing the U.S.-Canada FTA. And then General Powell asked me to embark on a series of talking points explaining why this trade agreement was a good idea. And I started on them, and Mr. Reagan very politely interrupted me, and he said, "You don't have to brief me on the virtues of free trade. I remember the Smoot-Hawley tariff." Let me just read from a final passage of the speech I did give, and on U.S.-Canada relations. "These experiences at the culmination of my time in government service confirmed to me what I had been learning gradually during the entire 44 years of my diplomatic career. First and foremost, we are neighbors, friends, and allies. It is difficult to imagine a more important relationship. In that context, Canada plays an instrumental global role which needs to be appreciated, whether it is as a G7 country whose voice counts in global financial circles, or as a strong NATO ally whose sons and daughters have been sent into harm's way in such far-away places as Afghanistan. As a neighbor and partner in regional cooperation, whether in NAFTA or the Western Hemisphere as a whole, Canada has made a substantial and consistent contribution to the growth, development, and prosperity of our part of the world. In this era of globalization, we must work together even more to enhance regional competitiveness if we are to avoid losing our edge to other parts of the world. Taking NAFTA to the next level and regulatory cooperation initiatives will be important steps in this direction. Finally, we are both Pacific nations facing westward towards peoples and economies which hold great promise and opportunity for the future of this planet. We've only lightly touched upon the diverse facets of U.S.-Canada relations, but perhaps I can close with the following thought. U.S.-Canada ties are not transient. Specific issues may come and go, and they need to be dealt with in a spirit that behooves neighbors, friends, and allies. There may be irritants that need to be managed, but we must never forget that the relationship is a historic and enduring one, as enduring as any such relationship can be. And this relationship has repercussions at all three levels of our respective diplomacies, the bilateral, the regional, and the global. So it is fitting that we nurture these ties carefully, that we not take our relationships for granted, and that we use occasions such as these to reaffirm the profound and enduring friendship between our countries. Now, Tom Enders understood all of these things. He understood them very well, and he understood them long before I did. And I just think I can't think of anything more fitting than to be meeting here today, Gaetana, in his memory and recognizing and remembering the superb work he did as a diplomat, as a national security official, and as you say, above all, as a Foreign Service officer who was willing to meet the needs of the service wherever they called him. Thank you.
Thank you so much.
Well, thank you very much, Ambassador Negroponte, and also Mrs. Enders, for really not just inspiring remarks, but a bit of history as well that we all need to know, and that is, in fact, very significant, particularly for this lecture series. Dr. Malcolm Knight, our speaker today, is a banker's banker. Now, let me tell you what I think that means. what I mean it to mean. Very few others can claim the huge scope of experience in banking that he has had at the very high positions of responsibility that he has held. In this, I think there's a kind of parallel with Tom Enders in another field. Because, as was mentioned more effectively than I can, Tom Enders was ambassador to Canada, to Spain, briefly to Cambodia, assistant secretary twice in crucial roles, had significant responsibilities in all of these trouble spots around the world. I guess all of this was basic training for Canada. I'm not sure, but it certainly it indicated the stature that he had, and the reason that people in Canada and the United States were so pleased at his appointment. Now, Malcolm Knight, too, has had extraordinary scope of accomplishment. Malcolm Knight started out as an academic, but he soon saw the light, and there were greener pastures. So he entered the research division of the IMF, where he authored a number of important papers, and I know that a number of these were broadly read because they were repeated or summarized in The Economist magazine. And there are very few policy pieces that get to that level. But then he quickly moved into operational areas. He was deputy director of the Middle East Department at the IMF, the Monetary and Exchange Affairs Department, very important division, European One. But at that point, and I guess what we'd have to say is he was a fast learner, if he could go through all of those things that quickly. He then became number 2 in the Bank of Canada in Ottawa, overseeing or responsible for strategic planning and participating in the overseeing of the bank's daily operations. Then he left Ottawa to become general manager of the Bank for International Settlements in Basel, the first North American to hold that job. Since 2008, Malcolm Knight has been a vice chairman of Deutsche Bank, overseeing the firm's relationships with global regulators. And as I understand, that's in some respects a continuing responsibility. Meanwhile, Dr. Knight has held teaching positions at the London School of Economics and for many years, and very importantly, here at SAIS and Canadian Studies as well, where I must tell you, he was a star teacher. He is the recipient of an honorary PhD from Trinity College, University of Toronto. I think you can see why we believe Malcolm Knight is the perfect person to address the topic of this lecture, Surmounting the Financial Crisis, Canadian and U.S. Banks Contrasted.
Well, thank you, Chuck, for that very kind introduction. Mrs. Enders, Mr. Ambassador, ladies and gentlemen, it really is an honor for me to give this inaugural Thomas Enders Memorial Lecture. I did not know Thomas Enders personally, but I certainly knew him by reputation. He was a fine and dedicated public servant and a great ambassador to Canada and a person who really furthered U.S.-Canadian relations during his time there. Today, I want to talk about a subject that is, I think, of interest in both countries, and that is the question of how the banking systems in Canada and the United States weathered the financial crisis of 2007 to 2009. And it's a very interesting question because the Canadian and U.S. economies are probably the most integrated across the most sectors of any two countries in the world. And yet their banking systems were affected very differently by the crisis. The U.S. financial system came near a meltdown in late 2008. Canada's banks weathered the crisis largely unscathed. Canada's banking sector alone among those of the G7 countries continued to provide comprehensive financial services efficiently to Canadians without government finance bailouts or capital injections. Why was a crisis that began on the doorstep of Canada such a wrenching event in the United States and such a passing event in Canada? What I want to do in this lecture is to try to talk about the reasons for those differences. And there's a paradox here. A highly productive economy needs a sophisticated financial system, one that offers savers access to a wide menu of financial instruments, supplies credit efficiently to borrowers, and transfers risks among different market participants. But I think the experience of the crisis really shows us that a complex financial system can become very unstable in times of stress. So what are the structural characteristics that account for the strengths and weaknesses of the banks that are at the core of the financial system? I think there are 6, and I'd like to list them before I go on to talk about the historical issues here. First, solvency and leverage. That's the amount and the quality of the capital that an institution holds to cover its losses relative to the size and riskiness of its total assets. Second, funding stability. That is the stability of the bank's deposit liability base. Third, maturity mismatches, the extent to which banks borrow short to lend long. Fourth, interconnectedness, the degree to which banks and other institutions are linked together through markets in ways that can cause stress and contagion to be transmitted from one troubled institution to others that would otherwise be healthy. Fifth, concentration, the size of the largest institutions in the system relative to the financial services market as a whole. And sixth, complexity of the institutions and markets at the core of the system. And as we will see, each one of these structural characteristics had an important role to play in the differing experiences of the two banking systems. Well, what were the structural characteristics, and particularly the structural differences, between the U.S. and Canadian banking systems in mid-2007, just before the crisis began? The U.S. banking system comprised nearly 8,000 institutions, from the 20 huge bank holding companies like Bank of America and Citigroup and J.P. Morgan, to thousands of community banks throughout the country. It also had a broader spectrum of non-bank financial institutions than Canada, securities firms, money market mutual funds, monoline insurers, and so forth. And central to the U.S. system before the crisis was a small group of lightly regulated investment banks, Bear Stearns, Goldman Sachs, Lehman Brothers, Merrill Lynch, and Morgan Stanley, that dominated securities underwriting, proprietary trading, advisory services, and acted as broker-dealers for hedge funds and private equity firms. In Canada, before the crisis, 5 large federally chartered banks had national franchises, and a 6th had a dominant regional presence. Canada, like the United States, had and continues to have an important insurance sector and active credit unions. But the trust companies, the securities firms that once were separate pillars of the Canadian financial system had been absorbed by the Canadian banks by the early 1990s as deregulation permitted them to consolidate into universal banks. On the liabilities side, each Canadian bank had an extensive branch network throughout the country that gave it a stable deposit base. U.S. banks were more reliant on an interconnected web of wholesale funding. The asset side of Canadian banks' balance sheets was also far less interconnected than that of their counterparts in the U.S. Canadian banks' main business was to originate corporate and household loans and to hold them to maturity. And of course, U.S. banks also did traditional lending, but over the preceding decade, they'd been aggressively conserving on their capital usage by packaging loans into structured credit products, selling them to investors, and thereby clearing their balance sheets for the next profitable round of securitization. So on the eve of the financial crisis in 2007, the Canadian banking system was more concentrated than that in the U.S., but much less reliant on wholesale funding, far less interconnected and complex, and thus less vulnerable to crisis-induced seizures of securitization or the collapse of structured products. And these differences would prove crucial to the contrasting ways that the crisis evolved in the two countries. Now, of course, these structural differences had their roots in history. In the United States, with its huge immigration west, a lot of small community banks grew up during the latter part of the 19th century. Canada, on the other hand, was a country with a small population and very focused on industries like mining, energy, and transport that required large banks that could tap international financial markets. But to an even greater extent, I think that the structural differences of the banking systems in the two countries, at least by the early 2000s, were the result of different political choices. And those political choices were reflected in different goals and different ways of operating of financial regulation in the two countries. U.S. regulation during the 1930s, of course, was profoundly shaped by the trauma of the 1929 Wall Street crash and the Great Depression. But during that period, not a single Canadian chartered bank or major insurance company failed. In the United States, excessive risk-taking by banks was seen as the key trigger of the Depression. And the key to mitigating banking crises is to address the dilemma that bank depositors want to be able to withdraw their deposits on demand, whereas banks earn their profits by lending for much longer periods with a significant risk that their loans won't be fully repaid. So if the depositors lose confidence and start a run on their deposits, banks may quickly become illiquid and insolvent. In order to reduce that risk, depositors need to be protected by deposit insurance, and banks need to be able to borrow from the central bank in times of stress. But since banks that have access to central bank liquidity have a profit incentive to expand their leverage beyond the levels that are socially optimal, they have to be regulated to ensure that they don't make the system unstable. So the 1933 Glass-Steagall Act tried to resolve this dilemma by separating banking institutions into two categories. The largely unregulated investment banks that could do securities underwriting, advisory services, customer lending, but also take positions in financial markets to earn proprietary trading profits. And given the risk that these activities had, these institutions were prohibited from accepting retail deposits and from liquidity support from the Federal Reserve. Regulated depository institutions, that's commercial banks, savings and loan associations, and mutual savings banks, could accept deposits from customers and make loans to businesses and households, but they were prohibited from undertaking most types of investment banking. So they benefited from the government safety net, and consequently, they had to be closely supervised to ensure their soundness. And so consistent with this two-pillar structure, Glass-Steagall established the Federal Deposit Insurance Corporation as the government insurer of retail deposits and the agency responsible for resolving distressed banks. Now, during World War II, banking regulation was sharply tightened in both Canada and the United States, really to facilitate the funding of the military effort. And that was accomplished, and this is important, it was accomplished mainly through pervasive controls on the interest rates at which banks borrowed and lent in both countries. So as the barriers to international finance were gradually dismantled in the 1960s and 70s, deregulation gathered pace. And it began earlier in Canada. And the reason I think is quite interesting. I think it's because in a parliamentary system, the government is responsible for elaborating a consistent and comprehensive overall design for the financial services industry. And in line with this responsibility, the Bank Act, which is the framework legislation for Canada's financial system, requires that the federal government periodically reassess the legal and regulatory framework to foster Canada's long-term growth. So the regular updating of the Bank Act, which was initially every 10 years and now is every 5, really focuses the attention of government and parliament on developing the entire financial system to meet the needs of international competitiveness and financial stability. So in 1960, the Canadian government appointed a Royal Commission on Banking and Finance. It was called the Porter Commission after its chairman, and it reported in 1964. And it really is a classic in the analysis of the structure of a financial system. And to a remarkable degree, I would say that the structure and regulation of the Canadian banking and financial system have evolved consistently with the recommendations of the Porter Commission ever since. And subsequent Bank Act revisions over the whole period to the late 1980s set the Canadian financial system on a path of phased deregulation that allowed banks to broaden their activities greatly by acquiring the previously independent securities dealers, trust companies, mortgage companies that had been part of the landscape. And the 1980 revision allowed banks to hold mortgage loans through subsidiaries and to trade in government and corporate securities. Subsequent revisions extended the bank's business to investment counseling and wealth management. And the way that Canadian regulation was implemented also changed. In 1987, the government responded to the failures of two small regional banks in Canada by establishing the Office of the Superintendent of Financial Institutions, typical Canadian name. And that is the agency responsible for supervising all federally regulated financial institutions. And OSFI quickly moved to strengthen bank solvency. It imposed minimum capital requirements of 7% for Tier 1, 10% for total capital. And it also specified, and this was well before anybody else had this restriction, specified that at least 75% of core Tier 1 capital must consist of common equity. So the fact that OSFI required Canadian banks to hold higher ratios of capital and lower leverage ratios has made them more robust to unexpected shocks than banks in the United States and elsewhere. So by the eve of the financial crisis in mid-2007, successive revisions of the Bank Act had established a Canadian banking system that was well capitalized, not excessively interconnected or complex, closely supervised, generally conservatively managed, and grounded on a stable nationwide funding base. But by reinforcing the tight oligopoly of a handful of banks, deregulation greatly intensified the potential problem that Canada's banks could become too big relative to the national market to be allowed to fail. More about that later. Now, deregulation in the U.S. banking system began later than in Canada. It didn't have really a comprehensive design, and it wasn't phased in a clear sequence. But ultimately, U.S. deregulation affected the structure of the U.S. financial system more profoundly and less predictably than the regulatory evolution in Canada. Up to the mid-1980s, U.S. banks and savings and loan associations remained subject to the ceiling interest rates under the Federal Reserve's Regulation Q on both their deposits and their loans. And at the time that these ceilings were finally lifted in 1986, it happened that U.S. market interest rates were rising strongly. So as a consequence, banks and S&Ls suffered stress from substantial outflows of funds because their liabilities were of much shorter maturity than their assets. And in an effort to limit the risk of holding these long-term assets funded by short-term deposits, U.S. banks began to focus on securitizing mortgages and selling them off their balance sheets. So deregulation in the United States unleashed an unexpectedly large expansion of securitization of credit products, mainly backed by residential mortgages. And of course, this is a change in U.S. regulation that, as we all know, had very far-reaching consequences a few years ago. From 1988 onward, U.S. bank holding companies were permitted to operate securities affiliates, and they were also allowed to expand into investment banking activities and to create off-balance sheet special purpose vehicles. And these moves really encouraged the growth of what we now call the parallel shadow banking system, that consisted not only of bank-sponsored special vehicles, but also of independent money market mutual funds, asset-backed commercial paper programs, and institutions that undertook bank-like activities without being in the scope of the regulation of commercial banks. So these markets quickly became highly specialized and interconnected. Bank holding companies expanded their commercial paper borrowings. Investment banks borrowed through short-term repurchase agreements. And in turn, these were held as assets by the money market mutual funds, other institutions in the United States, but also to a surprising degree by banks in Europe and elsewhere. So as a result of this, financial system leverage and complexity increased in ways that the regulators failed to see. Just to give you an example, at its peak on the eve of the crisis, the shadow banking system was funding about $8 trillion in assets. And that compares with assets in the regulated banking system of just over $13 trillion. So it's much more than 50% of total credit intermediation in the United States. So in sum, by the 1990s, financial deregulation in the United States had encouraged the growth of about 24 very large bank holding companies, and it had made investment banks more focused on securitization, broker-dealer activities, and interconnected proprietary trading activities. The Gramm-Leach-Bliley Act, which was passed in 1999, was just, I think, the final stamp of official approval on a long process in which bank holding companies consolidated their traditional banking activities with proprietary trading and other activities that made them into supermarket banks, conglomerate structures. Now, as a result of these changes in the U.S., much more financial intermediation also took place through markets rather than just on the balance sheets of the banks. In contrast to Canada, where the bank's business models continued to focus on borrowing directly from and lending directly to the non-financial sector, the shift of large U.S. bank holding companies and investment banks to this originate to then distribute strategy for credit products increased complexity and the interconnection between U.S. financial institutions and markets. But unlike loans that are held to maturity, traded credit products have to be continuously valued at market prices. And so the Achilles heel, if you will, of the system was that such prices can be caused to fall massively when leveraged investors, as a result of some stress, are forced to deleverage and engage in asset fire sales, because that can then feed back, as it did, on the equity of banks and other core financial institutions. Now, on the eve of the crisis, the effectiveness of cooperation among regulators also differed in the two countries. In Canada, OSFI's microprudential supervision was and is embedded in a larger structure of macroprudential regulation in which all the key government agencies responsible for the stability and the efficiency of the Canadian financial system cooperate closely. In the United States prior to the crisis, I think it's fair to say that financial regulatory and supervisory responsibility was fragmented among a large group of federal and state regulators. I only need to list them: the Federal Reserve, the FDIC, the Comptroller of the Currency, the Office of Thrift Supervision, the Securities and Exchange Commission, the Commodities and Futures Trading Commission at the state level, or at the federal level, plus 50 state banking commissions and 50 state insurance regulators. Quite a group. And I think it was a bit of an opaque arrangement that created really significant regulatory gaps and overlaps and coordination challenges. And one important example is AIG, which at the time was the largest insurance firm in the world. It essentially had no regulator for its massive shadow banking activities, its credit default swap protection activities. So this lack of regulatory clarity and limited coordination contributed a lot to the difficulties when the crisis struck. Well, financial system leverage increased markedly in the U.S. during the early 2000s. And that was particularly associated with a very rapid rise in their trading books relative, that's their fair valued, market value trading books, relative to their total assets. Because the Federal Reserve held policy interest rates at low levels, credit rose rapidly. Although consumer price inflation remained subdued for a lot of reasons that I'm not going to go into here, this very rapid growth of credit caused the prices of assets to rise, particularly residential real estate. And those increases occurred pretty much continuously and in very large amounts from the late 1990s to 2006. 2006, however, asset price increases, housing price increases, suddenly ground to a halt. And then the credit rating agencies began in May to July of 2007 to unleash literally a cascade of downgrades in their ratings of structured credit products, particularly those backed by residential mortgages. This profoundly unnerved markets, and in August of 2007, what we call a Minsky moment, after the great Hyman Minsky, who really gave the first clear analysis of financial crisis. A Minsky moment occurred in which investors en masse, in a group, suddenly withdrew from risk. That was the beginning of the international financial crisis. Now, the dynamics of that crisis were, of course, very different in the United States and Canada. And it's not really worth going into all the details of those different dynamics. But I do want to distinguish them. And I do that by distinguishing two distinct phases of the crisis. Phase one, which was from August of 2007 to February of 2008, was the period when the interbank market seized up and the funding sources for banks' special vehicles also evaporated. And phase two was the period of intense deleveraging, asset fire sales, and financial distress that lasted throughout the whole period, really, from February to December of 2008, and which really brought a near meltdown in the latter part of that year. And Canada was very strongly, if briefly, affected by phase one of the crisis, but much less so by the second phase, which was really the one that everybody remembers here in the United States. So in August of 2007, banks in both Canada and the United States were faced with a sudden outflow of funding from asset-backed commercial paper programs and other leverage off-balance sheet vehicles. Canada's banks, of course, had the advantage of not being as involved in securitization and also of having a stable funding base. But they also benefited, and I think this was more important, from the Canadian government's early decision to impose an immediate moratorium on repayments of ABCP borrowings until the problems in this market could be resolved. And with these measures, Canadian banks were really quickly brought back to an even keel. But in the U.S. and in Europe, banks were much more dependent on borrowings in the interbank market. And here something very unprecedented happened. Owing to the growing concerns about the appropriate valuations of banks' assets, the banks that had liquidity stopped lending to those that were short, because that's an unsecured market. Interbank interest rates skyrocketed, and that forced the Fed and the European Central Bank to lower policy interest rates aggressively and provide massive amounts of liquidity in a coordinated fashion throughout the rest of the year, throughout the rest of 2007. The second phase of the crisis began in early 2008 when the investment bank Bear Stearns experienced an evaporation of its funding. And it, of course, had to be acquired by J.P. Morgan with assistance from the New York Fed. Lehman Brothers, which also experienced funding strains at that time, spent the spring and summer of 2008 attempting to strengthen its capital base by offering a large block of mortgage-backed securities for sale. But it wasn't able to accomplish this at its asking price, and Lehman found that its funding had evaporated by the middle of September. And of course, U.S. regulators decided that they had no choice but to let it fail. And that was immediately followed by the problems of AIG, which, unbeknownst to regulators, had been selling massive amounts of credit default swap protection. As uncertainties increased about the valuation of assets held by U.S. investment banks and other highly leveraged institutions, they also ran into funding problems. And the remaining U.S. investment banks were severely weakened by this, causing them to either be acquired by stronger rivals, as in the case of Merrill Lynch, or to convert themselves, as Goldman Sachs and Morgan Stanley did, into bank holding companies in order to be able to access the U.S. government safety net. Well, that panic spread to money market mutual funds, monoline insurers, European specialized mortgage lenders, and it undermined solvency and liquidity of even the largest U.S. bank holding companies. And so to forestall what looked like it was going to be a complete meltdown, U.S. and European governments introduced blanket guarantees for their banks, and central banks reduced policy interest rates further, vastly expanding their balance sheets. This calmed the fears and brought the global financial system back from the brink of chaos. But this second phase of the crisis had only a very limited impact on the Canadian banks. Why? Because they had sound loan books, they had stable sources of deposit funding, and they had limited involvement in securitization. And these structural characteristics, coupled with the shock-absorbing qualities of the floating Canadian dollar, allowed the broader Canadian macroeconomy to weather the crisis with much less severe impacts on output and employment than were experienced in other countries. So that's the crisis and the different structural features that were important for it. What conclusion should policymakers and regulators, and indeed banks themselves, draw from the sharply contrasting experiences of the U.S. and Canadian banking systems during the financial crisis? I think that the U.S. authorities have learned at least 6 really fundamental lessons. First, starting with the troubles of Bear Stearns, U.S. regulatory authorities realized as early as February of 2008 that they needed to step in quickly to resolve stresses rather than letting them fester. And so they injected capital into large distressed banks in ways that would later allow those banks to denationalize themselves as soon as the worst period of the crisis was over. Second, from early 2009, U.S. regulators began undertaking regular cross-sectional assessments of the capital adequacy of the 19 largest U.S. bank holding companies. And by clearly disclosing to markets the financial condition of each bank on a consistent basis across banks, U.S. regulators have been able to very markedly strengthen market confidence in the viability of the institutions that lie at the heart of the U.S. financial system. Third, U.S. authorities now better understand the high degree of interconnectedness in their market-based financial system and the ways it can contribute to system-wide strengths. And I would say that for all its weaknesses, the Dodd-Frank Act of 2010 at least recognizes that the guarantee which regulators had implicitly extended to too-big-to-fail banks prior to the crisis undermined financial stability by allowing those banks to borrow at cheaper rates than their smaller competitors to fund risky proprietary trading and securitization operations that were infected by the fire sale psychology when the crisis struck. Fourth, they've also recognized that the business model of institutions like the investment banks that relied on collateralized funding becomes very unstable in times of stress. What were once bank runs of retail deposits now show up in the evaporation of wholesale funding in the interbank markets, in the repo markets, and in other markets that are tightly interconnected. So at the micro-prudential level, I think this has raised U.S. authorities' awareness of the need for banks and indeed systemically important non-bank financial institutions to maintain higher levels of solvency and liquidity. At the macro-prudential level, it's led to the establishment of the Financial Stability Oversight Council, chaired by the Secretary of the Treasury, and including all the key U.S. federal financial regulatory agencies. The FSOC will focus on identifying and mitigating evolving system-wide vulnerabilities that weren't apparent to the fragmented regulatory structure that existed before the crisis. Fifth, the U.S. experience of the crisis has led to the recognition that when the interconnectedness of the financial system is high and traded credit is large, any shock can cause abrupt fire sales that can impair the functioning even of the largest banks and of the whole financial system. And sixth, the U.S. experience of the financial crisis focused attention on orderly resolution of key financial institutions through new regulatory instruments, such as living wills and greater FDIC powers to restructure and wind up troubled firms. And also, I hope, to further thinking on bail-in resolution regimes that will permit distressed institutions to be resolved at the cost of stakeholders and creditors rather than massive taxpayer support. So these are really crucial lessons, and they will, I think, over time, significantly strengthen the U.S. banking and financial system. What about the Canadian banks? Here I have only two things to say. What about the Canadian banks? Well, clearly they weathered the recent crisis relatively well. Should we conclude from that banks in Canada are robust to any crisis? Unfortunately, I believe the answer to that question is in the negative. Now, my judgment is that macroprudential regulatory oversight in Canada was much more effective than that in the U.S. and other countries prior to and during the crisis. But there are still at least two important weaknesses in Canada. First, the Canadian banking system is really highly concentrated. And owing to their massive size relative to the Canadian market, the largest Canadian banks create, in my view, a major too-big-to-fail risk. They have stable funding. They have limited interconnectedness. They have high capitalization. And that doubtless makes Canadian banks less likely to fail. But it's difficult to believe that the Canadian authorities would be able to stand by and let one of them succumb to stress. The impact on customers, on competition in financial services, and on the authorities' own reputation would simply be too great. A second weakness is that, unlike the U.S., Canada still lacks a national securities market regulator, although I have to say that the Canadian government has been making enormous efforts to establish one. Now, one of the lessons from the crisis is that in a market-based financial system, stresses can be transmitted and magnified by those markets. So financial market regulators, we used to think of them as assuring the efficiency and fairness of financial markets, but they actually have a major macro-prudential responsibility to ensure that markets continue to give correct signals at times of financial stress and to mitigate the risk of markets causing asset prices to overshoot on the downside. So the establishment of a national securities regulator similar to the SEC and the CFTC in the United States is essential, I believe, to strengthening the prospects for financial stability in Canada. And there's one final irony, I think, in my story. I've emphasized in this lecture that mortgage lending is a much more stable market in Canada than in the United States. But the zero policy interest rates and the quantitative easing that are currently being implemented by the U.S. Fed, the European Central Bank, and the Bank of Japan, however appropriate they may be for those countries, are nevertheless causing major spillover effects to other countries. And those create substantial risks for the Canadian financial system. Low interest rates cause savers to reach for yield by taking on more risk, and they cause borrowers to overborrow. And the irony is that currently these problems are evident in Canada's real estate market. Canadian banks have rapidly expanded their commercial real estate lending. And while each bank would certainly tell you that its own commercial real estate lending book is extremely prudent, the total level of credit in Canada is expanding very rapidly. And this creates a considerable risk of an unsustainable asset price bubble in real estate. And although the Canadian authorities, I think, have reacted appropriately by tightening lending standards, their marge de maneuver to raise policy interest rates to slow lending growth is constrained by the need to avoid an excessive exchange rate appreciation that could damage Canada's international competitiveness. So in sum, low global interest rates and the too big to fail problem are two major financial risks for Canada going forward. And one of those is caused by external factors, but the other is homegrown. Thank you very much.
And now our distinguished chairman of the Enders Foundation, Richard Gervais, will say a few more remarks.
Are we not first asking for questions from the learned lecture we've just had?
Well, let's do that. Yeah, we can proceed with that. And you can be the penult of the actual thing, the ultimate thank you. So let's entertain some questions here. We have about 20 minutes. Let's keep the questions short and maybe the answers short so we can get through as many as possible. We have microphones on either side because the room is fairly large. So if perhaps you could go to the microphone and we'll start.
My question is about the Mark Carney's letter to the Treasury a couple weeks ago about the local rule of exemption for U.S. Treasury bonds in the securities markets. Do you think that was a valid criticism? If Canadian bonds were also exempted, would that be a fair way to go about it?
Let me answer that not as a... Okay. The question is that the governor of the Bank of Canada wrote to the U.S. Treasury Secretary arguing that the sovereign debt of other countries should have the same exclusion from the Volcker rule that U.S. Treasuries will have. This is very important because these are huge markets and they have to operate efficiently. And so it was recognized in the case of the U.S. Treasuries market that if large financial institutions weren't able to take pretty big proprietary trading positions in these instruments, those markets would not operate as efficiently and it had cost the Treasury, which means you, the taxpayer, more to manage the fiscal system. And that's an important point that we all ought to think about when thinking about the inefficiencies that might be created by implementation of a really strict Volcker rule. But here I think the issue is really more one of the huge importance of ensuring that major elements of financial regulatory reform are internationally consistent. It was because we had gaps, because some of us wanted international champions, because some countries wanted to let their banks have a little lower capital requirements than others to give them a competitive advantage. That was one of the major elements of why we ran into this problem. And so I think the issue here is that it really is appropriate to think in terms either of including all Treasury securities so that they're in the Volcker rule, including U.S. Treasury securities, or excluding all Treasury, all sovereign instruments. And I think this is the issue that the Canadian governor was concerned about. Very much up for grabs. If I am allowed one more comment. I understand exactly where the Volcker rule is coming from. I understand its importance. I mentioned it in my lecture, actually. But the way it will be implemented in the United States may cause some quite significant inefficiencies in the system, and that will cost all of us as borrowers and savers in the market. So it's a question of balancing two elements.
Thanks very much for a very interesting talk. Many people in this country have said that the repeal of the Glass-Steagall Act was the reason or one of the reasons why we had a crisis. But as you pointed out in your talk, Canada combined its investment banking and commercial banking very largely with the absorption of the investment firms by the commercial banks and the creation of universal banks. So it looks like the Canadian more stable experience might suggest that the only problem with Glass-Steagall in the U.S. was that we didn't get rid of it earlier. Is that a fair comment?
The Glass-Steagall Act actually still exists in the sense that U.S. commercial banks, that is depository institutions, are still prevented from undertaking proprietary trading activities. The proprietary trading activities take place in the subsidiary of the bank holding company. And I think the problem in the United States, or the big challenge, is that the U.S. financial system has moved really far beyond a situation where the simple separation included in Glass-Steagall really can function efficiently. Now, that said, there are still ways of doing structural separation. The Vickers Committee in the United Kingdom has suggested a different approach to ring-fencing the utility activities of banks from, or bank holding companies that have banks, from riskier activities. My own feeling is that probably the Vickers approach, if you want to do structural separation, to limit the possibility that risky risky proprietary trading activities can infect the efficiency with which banks do other crucial things like providing bank accounts for us all and managing the payment system. If you want to do that, I think the Vickers way of doing it is probably a more efficient one. But the larger problem here is twofold. One is the too big to fail problem. And I think the U.S. is actually making more progress on that probably than Canada is at this stage. And the other is the fact that the problem in the system is really too much interconnection and too much financial system leverage. So the U.S., what I believe is that the regulatory authorities should try to control leverage more directly, possibly by increasing the taxation of raising funds through debt relative to raising it through equity. And the last point I would make is that, as I suggested, I believe that although the concentration of all of these formerly separate financial activities in Canada into supermarket universal banks in Canada made the Canadian banking system more efficient and competitive than it otherwise would have been, it augmented the too big to fail problem.
Chris?
Thank you. Thank you very much for the talk. And I have to say I was lucky enough to have you here when I was a Sci student for class, and I had a sort of nostalgic flashback for those days listening to you here again. It was great. I wanted to ask you about Canadian Finance Minister Jim Flaherty's remarks with regard to the IMF, another important part of the international financial system, suggesting that the Europeans have too much voting weight, particularly where their own interests are concerned, and that the way that the IMF is governed should be revised now, particularly where Europe is concerned. What's your thought on that?
Well, I have to declare an interest here. I am an alumnus of 25 years at the International Monetary Fund, as Professor Duran mentioned. I do believe that there's a major issue in the voice of the member countries of the International Monetary Fund. I think it's clear to everyone that the emerging market economies as a group don't have a voice which is commensurate with their importance to the global economy or the kind of risks that they could create if something went wrong. And I think it's also a fair perception that some of the smaller European countries now have probably more voice than would ultimately be desirable. So I think that's really a fairly uncontroversial idea, and the fund has already taken some steps to improve the voice, at least of the BRICS, the bigger, the large and really important emerging market economies. But there's another problem here, which is, I think, a very interesting one that you raise, and that is that one of the reasons that the International Monetary Fund now needs to raise funding is that it is very heavily committed in Europe. And I think the other 170 members of the IMF, member countries of the IMF, really believe that they have to have assurance that whatever additional funding the fund gets would be not for a specific purpose, but would be for the general purposes of the fund. With the fund so heavily exposed, not necessarily in an optimal program in Europe, I think that that is a bit of a hard sell. And I think it is actually appropriate for finance ministers and treasury secretaries, as they both have, to make public statements about their concerns.
Hi. You recommended transparency in bank solvency as one of the takeaways that U.S. regulators could have from the crisis. But one of the big problems in the early stages of the crisis was that banks who had access were unwilling to come to the discount window because they didn't want to appear insolvent. And American authorities acquiesced to that, and there was some degree of success as a result. Is there a balance there as to when it's sort of appropriate, and what kind of transparency and solvency exists in the Canadian bank market?
Yeah, I do think there is a balance in transparency, and I think you raise a very, very good point. Fundamentally, I believe that everybody has the right to know the valuations of assets, maybe of all corporations, but certainly of large financial corporations. And prior to the crisis, that really was not so. One bank, which I will not name, had 70 special purpose vehicles off its balance sheet that it became responsible for to provide liquidity to when the crisis broke. That's not transparency. And the absence of transparency on asset values always distorts the way financial markets work. Now, when, however, a financial institution cannot get funding, if the authorities are confident that it is solvent, they should lend to it. And while I'm certainly not opposed to aggregate information being provided on that pretty soon after the operation takes place, I'm not entirely comfortable with information on individual institutions being provided, certainly not in real time. Because the whole problem there is that the market's not working. If the market knew that those institutions were solvent, then it would lend to them. So here I think we have a problem of market failure, which happens a lot, and that's a major job for a central bank. And I think that the freedom of information requirements for the Fed went pretty far in doing some things that really might not prove to be productive in a future crisis.
Okay, our last question.
I was wondering if you could comment on the weakness of money market funds during the crisis and the concerns about their safety right now, and also regarding if they are shrunk, how corporations will finance themselves short term.
Well, it isn't just corporations. The money market mutual funds, at least up to May of last year, were major sources of dollar funding for the European banks. The degree of interconnections here is very large, and the money market mutual funds even now are on the order of 3.7 trillion in the United States, a little more than that, and a little less than $3 trillion equivalent in Europe. So they're very big players. I think that the current regulatory environment for the money market mutual funds, it's been improved a little bit, by the way, but it is really not appropriate. We are either going to have to, I think we can split money market funds into two types. The ones that deal with retail customers, maybe fairly sophisticated ones, and the ones that deal with only with other big players. And I think that the ones that deal with retail customers should have capital requirements similar to those of banks. They may be much less because these are effectively niche banks. They should have capital requirements, and then they should have possibly access to the Fed and the safety net of some form of insurance, though much less than for regular bank deposits. And the ones that that operate in the wholesale markets should have a floating asset value, just like all other funds. That's my view, and I think it's a simple solution. But there are some major political interests here.
Well, Mr. Knight, you've certainly educated us considerably. Not all of us are as well versed, I think, on the subjects that you've raised, but you've certainly highlighted the differences between our two countries on that subject. And your last comment on the integration of the BRIC is certainly a challenge that both countries face. It's a very serious matter, in my view. So I want to thank you for having accepted to inaugurate our Anders lecture series. This is a first. It's certainly a successful first. I want particularly to thank Professor Doran for having made that possible and having suggested you and spoken to you on our behalf. It's been an extremely educational 2 hours, perhaps we'll have another chance to pick your mind one day. I hope so. I want to thank Ambassador Negroponte for having taken the time, first of all, to come here out of great friendship with the Enders family, and also steal my speech, because you are so more learned, and the comments you made on the speech you made recently were parts of the comments that I don't want to be repetitive, that I wanted to make, because just to add to my brief introduction, I'm a political scientist, and early in my life I was the assistant to the Foreign Minister of Canada for 4 years, and I was privileged, very young, to come to the White House and come here and discover the great differences, the great friendship, and yet the great lack of knowledge of our country in the United States. And then I'm a Fordham graduate, so I also had discovered all this, and then there's a lot of lack of knowledge in our country of the United States. For instance, I said to a group last night that in Philadelphia, at the first Congress, you had kept a seat for Quebec because you had failed to, with the small invasions in 1812 and prior, to convince the former the colony members who had escaped the United States to stay under the British Crown. So you then decided to try to convince us French Canadians and had kept a seat in Philadelphia. These are little examples of the need to know one another a lot better. And in sectorial sectors, of course, with a learned guest like you, the differences become evident. Most Americans don't know that we're basically a confederation and not a federation, and that we're very decentralized despite our few chartered banks. It's a bit contradictory, and that all temperature permitting, due to our size, our premiers of provinces are much more powerful than your governors. And the present administration of Prime Minister Harper is decentralizing the federation further, because Harper, being a Westerner, has probably suffered from the arrogance of the central government, and he is now moving out of a lot of areas that were invaded by the federal government of Canada over the years since the war, particularly, and sometimes for war reasons, but then they never left. So that is another difference between our two countries. And then, of course, we have the two official languages and the Quebec reality. Quebec has really become almost a state within the Confederation. I'm a federalist. I fought all my life for that, but I'm not unhappy about this as long as it doesn't go further. And this also has to be understood in the United States, that there's that difference. And another difference is that the power that used to be in Montreal for 75% of the history of this country, of our country, political power at the federal level, moved to Ontario and now to Western Canada. And the country will never be the same. We have to accept this as a confederation. It's the growing provinces in population and wealth are the Western provinces, and this will have an impact on the relations and the adjustments in the bilateral relations. In closing, I just want to say, because I do not want to be repetitive and we're behind schedule, but we are your best friends. We do share the longest peaceful border in the world. We share a language. We share a fight for liberty and freedom. We've not always been with you, but almost always. And sometimes we've acted with wisdom, I think, but it is not for me to judge, because you're the world leader, and that's a tough job. And people should appreciate the responsibilities of a world leader and their judgment. At any rate, so therefore we have all this in common, and I want to reassure you that being in my view, the wealthiest country in the world in natural resources, and the second largest territory, we are your security of supply. We're your friends. you will have our oil and gas and eventually water. We can't refuse water to our best friends. So this is a matter of delicate foreign bilateral relations, a matter of diplomacy between, as Pierre Trudeau used to say, the elephant and the mouse. It takes diligence. We have our pride, we have our sovereignty, yet we have our friendship. And that I want to conclude on this, and I want to conclude on thanking Gaetana Anders. It's been said, but it will never be said enough, that she was the heart of this whole endowment, and for the past 15 years has given bursaries, and now is inaugurating a great conference, and we had a great speaker and a great audience, which I would like to thank for having attended. And when Gaetana asked me to join the board, I was honored because of the purpose of that cause, because I really believe in it. And I thank you, Gaetana, for all that you're doing for the bilateral relations through this endowment, because we may be few here, but there's a multiplier effect. We're all influential people, and we speak and we repeat, and we're going to also distribute your speech widely. So, ladies and gentlemen, many, many thanks for your attendance.